All right, guys, so we're going to finish off where we left off with auto insurance. What I do want to make note of is, we talked about, your deductible. We talked about your premium. We talked about your policies. We talked about how they can be monthly, quarterly, or yearly. Now, the whole purpose of this is to explain, how are rates determined, okay? So when you're looking for a policy and you're doing your research, your rate is how much you're going to pay. It's going to be determined by your age. Okay, the younger you are, the more expensive your rate's probably going to be, and the more older you are, probably the more wiser you are, probably the more mature you are. So the less you're probably going to have to pay. Okay, your sex. Okay, that plays male or female. Okay, that plays a big role. Okay, and I'll explain why. Your driving history. Okay, if you have a clean driving history, you don't have that many tickets or don't have any tickets at all. You haven't got any wrecks. You're more likely going to save money and get a cheaper car insurance rate. However, if you've had multiple tickets and you've had, numerous numerous accidents. Pardon me, guys. Little man is upset, so you probably just heard him. All right, so we had your driving history, okay? Your type of vehicle, okay? The older your vehicle is, the less likely it's going to be, the rate is going to be expensive, okay? The newer your car is, however, it's going to be more expensive because it's more valuable. The value of your car is expensive or it's high, meaning that, it's, like I said, it's more valuable. So they're going to have to charge a higher insurance rate to essentially cover that newer car. Now, if it's an older car, your rate's probably going to be cheaper because it's ideally the insurance is not going to be worth the Kelley Blue Book value of your car. So it's going to be cheaper. Now, saying that correlates to number 5, age of vehicle. Okay, like I just said, the older your vehicle is, the cheaper your insurance is. The newer your vehicle is, the more expensive it's going to be. Now, let me ask you this. Who do you think pays the most? I'll give you a sec. That's right, teenage boys. Okay, I know that's kind of a shocker there. Some people may think, that's biased. Well, ideally, teenage boys are, okay? When teenage boys turn 16, the first thing they want to do, they want to hop in the car and go, okay? They want to have everybody in their car and just drive and, go crazy, have fun. However, this, essentially hurts, teenage boys because they are more likely to have more tickets. They are more likely to have more accidents. This causes the insurance rates to go up. Okay, and insurance rates and policy rates vary per year. I was actually redoing my auto insurance for my new truck, and I was told by the agent that all insurance rates in the state of Georgia were going up. Okay, due to teenage boys and younger adults, 18 to 24, as well as teenage boys, are more at risk to not having that clean of a driving history, having more wrecks or accidents, and then having more tickets. All right, so moving on, we're talking about health insurance, okay? The whole purpose of health insurance, I know it seems like a lot of text. You just need to know that if you're sick or injured, this comes into play, okay? Legally, okay, you can be covered by your parents until you're 19 if you're in school full time, or until you're 19, or if you're in school and full time until it says 23. It's actually been changed to 26. I know it says 25, but it's been 26. The Obama administration and former President Barack Obama actually passed a bill and a law to where you can stay on your insurance, your parents' insurance, until you're 26 years old. Okay. Now, how's the cheapest way, or what's the cheapest way? It's getting through your job, okay? This still requires a premium deductible that you still have to pay a premium, which may be monthly. Usually, it could be quarterly, also could be yearly. But this essentially, covers you at your job. It's probably the cheapest way, okay? And it's probably the best insurance you probably get, okay? You also got to pay deductible, and that's for every policy, okay? Now, Obamacare, it required, or the organization, the implementation, the plan required all businesses, with 50 plus people. Okay, this is essentially your smaller businesses. Your larger businesses have to offer minimum health care for every employee. That is a law. Okay. Now with President Donald Trump, that's actually trying to be repealed. It's in the process of that, and we'll see what happens. All right, moving on, your disability insurance. This is basically, if you suffer illness, it keeps you out of work for an extended period of time. What this disability insurance is, if you pay into it, this insurance will pay you 75% of your monthly income until you recover. Okay. Yes, this still requires a premium to be paid. And lastly, we're going to talk about life insurance. Okay. Now I know it says life insurance, but this is really death insurance. Okay. This happens, this insurance kicks in when you die. Okay. So the way it works is it provides money to people you leave when you die. The people who you give your money and your benefits to, these are known as beneficiaries. Okay. These are people who receive the money once you pass away. Now there's two types of life insurance. There's term. Okay. This is usually cheaper. This can range from 5 to 30 years. Once you pay into this life insurance, it's only for that set amount of term. Okay. Now this has to be renegotiated. Okay. The policy changes. It can go up. It can go down. Okay. This insurance, when you pay into only a term, if you die within that term, it pays off when you die. Okay. There's no cash value into it. Once you die, it covers your death. Your beneficiaries get whatever your, whatever it may be on your, your life insurance plan. But it's really just paying off when you die. There's no cash value to it. Now on the flip side, you have your whole life insurance. Okay. I'm not saying this is a better insurance, but it is more expensive. But it pays out less. Okay. So whereas in a term it pays a higher death benefit. Okay. So more than likely you're going to get once you die, everything covered based on your life insurance. Now on whole life. Okay. The good thing about it, it can be, from today, from 30 years from now, it's indefinite. Okay. You keep putting money into it that essentially will build in cash value. Okay. So not only will, it cover, your death expenses, it is going to have a built-in cash value to where, beneficiary or yourself, usually beneficiaries will, or yourself, can take out the cash or loans based on how much you put in. You get a set amount from that life insurance and you can take it out for loans or other expenses. Okay. So that should be wrapping up. All right. So that's it. We knocked out everything. Okay. We plan on having a test here shortly. If you have any questions, don't hesitate to ask. I'm putting all the PowerPoints on Canvas, and you also have notes on there too. Make sure you study your notes, look over your term sheets, and hopefully everybody does well on the test. If you have any questions, don't hesitate to ask. Thanks, guys. Have a good night.